All right, so when is sampling used? So obviously we know that as auditors we cannot look at 100% of the items. And so we have to make a sample selection. So we have to select items that we want to look at. And there are numerous ways that you can do that. But you want to perform that sampling selection so that the sample is representative of the population. You want to reduce your risk that you're going to that you won't select those items that are more problematic, right? Or that you miss something, right? Because remember, there is going to be this risk that we don't catch something because we're not looking at 100% of the items. So we're trying to minimize that. Right? So with sampling, you know that exact information is not needed, because if you need exact information, right, you're going to have to look at 100% of the items. Not possible in an audit. You can't possibly do that. You know that there are large populations, right? Large amounts of transactions. You take a company the size of IBM or Microsoft. Just imagine the amount of transactions that are flowing through there. So how do we, as auditors, get a handle on that and select a representative sample? By doing that, what you're trading off on is effectiveness for efficiency, right? Because sampling is more efficient. Right, that we can't look at 100% of the items, and you have a constrained time period in which you can audit, right? You can't sit at your client for 365 days of the year. Doesn't happen. So you're trading off the effectiveness of looking at a lot more items for efficiency to focusing on fewer items. So with sampling and auditing, we look at sampling to test compliance with internal controls. That's a test of control. So we're going to sample, say for example, select a sample. Remember when we were talking about the assertions over the sales and collection cycle, I would use the term select a sample of sales from the sales journal and tie those back to shipping to test occurrence. Right? So that's what we mean. We're going to select from a larger population and perform the test on those. So if we're looking at, let's say for example, we talked about the acquisition cycle last class, right? If we want to see that all disbursements are supported by the appropriate documentation, if there's a three-way match, we go to the cash disbursements journal, select a sample of cash disbursements, and then ensure that those cash disbursements have a purchase order, a receiving report, and a vendor invoice. That's a test of controls, right? So that's one way we use sampling, and that's what we call attribute sampling. So we're looking for the attributes indicative of those controls. So in that example, the attribute that we're looking at are vendor invoice, purchase order, receiving report. Those are the attributes that a cash disbursement should have with respect to controls over cash disbursement. We also have substantive procedures that we perform. And that's those procedures that we're performing on account balances. Not transactions, not controls, but on account balances. And so we're selecting components of those transactions or account balances for verification. And that's what we call variable sampling. Right? So the two chapters that you have in your text covers just a general overview of sampling and then attribute sampling. And what I'm going to provide you with on the internet is a discussion of variable sampling. So let's just talk about sampling in general. Because we're not looking at 100% of the items, we have risks, right? We already know that. We have audit risks, we have control risk and inherent risk and detection risk. So we know from the audit risk model that the audit is a risk-based audit, right? That there's risk that we're accepting as auditors because we cannot look at 100% of the items, because we don't control the transactions that flow through, and inherently we don't know management's motivations, right? We can only assess it. So we know that there's some risk that we might reach this incorrect conclusion based on our testing, right? Because we're sampling, we're going to select, let's say, 100 items out of maybe 1,000 items, and that's conservative, right? So that the 9,000 items, there might be an error in those 9,000 items that we didn't detect. right? Because we never selected those things. So there is the risk that the auditor reaches an incorrect conclusion because the sample is not representative of the population. Right? So when we talked about assertions and we talked about completeness and the importance of having pre-numbered documents, well, this is one of the reasons, right? You want to be able to reconcile that if there were 1,000 sales transactions in the year, that you can account for all of the sales orders from 1,000 to from 1 to 1,000. That your population includes all of the sales transactions that occurred. So you're going to look at the numerical sequence. And that's just, the sampling risk is just by the nature of the audit, it's an inherent risk, right, for the audit. I mean, it's just an inherent part of the auditing. So what we do to try to minimize that risk, right, as auditors is we control by determining what the appropriate sample size is. And then ensure that all items have an equal opportunity of being selected, and then mathematically evaluate the sample result. So most if not all firms have statistical sampling packages and their approach to statistical sampling. What I found interesting as I was just kind of reviewing the chapter for this lecture was that there was a little sidebar in there that about 74% of people responded to this survey that they actually use haphazard sampling, right? That is not statistical sampling, that is more haphazard, which is kind of surprising, especially in this day and age with the ability of technology. So for some weird reason, a lot of people are not using, or auditors are not using statistical sampling. But nonetheless, firms have their own statistical packages, and I'm sure on larger clients that they are using more statistical sampling techniques. Now, I remember when I was an auditor, we didn't have statistical sampling. At least we didn't use it on the audits that I was on. And when I was doing test of controls or something like that, testing transactions, I had to come up, we had our way of coming up with a random sample, because we needed it to be random. And so we kind of took this approach of, we want to look at, there are 1,000 items, transactions, and we want to look at 100. So, we figure out what that meant in terms of every nth item. And then I randomly closed my eyes, had a dollar bill, put my finger on it, and whatever that number was, that became my every other number I looked at, right? So that's where I started with. That was my random starter. And I looked, if my finger landed on a 9, then I looked at every 9th item until I reached, the required number of items that I needed to look at. So it wasn't statistical, but it was random, right? It was a random sample. Now, obviously, all of that stuff is done statistically, or can be done statistically. So non-sampling risk is the risk that your audit tests do not uncover, right? A material misstatement or an error or a deviation if it's in a control, or exceptions in this example. So that would be because the auditor has failed to do something, right? So the auditor failed to recognize that what was an exception, right? So for example, if the auditor was testing disbursements, let's say on this disbursement scenario, and they selected 100 disbursements, and one of there was an exception where the voucher package did not include a purchase requisition or didn't include a vendor's invoice. That's an exception. But the auditor didn't list that as an exception, right? Because they felt as though, well, we see the receiving report, so we know that the goods were received and there's a liability because we received it. By not having the purchase order in there, that's a deviation from that control environment, right? If the control environment calls for a purchase order, a receiving report, and a vendor invoice, the fact that there's no purchase order in that voucher package means that that's an exception. Now, whether you can figure out if it was actually received, there are controls in place. You are relying on controls that says that disbursements are only made when we have this three-way match, right? Because what happens there, right, is if you don't see that control as an exception, yeah, you know they received the goods, but you don't know if the purchase was authorized, right? Because that's what the purchase order tells you, right? You don't know if they paid that invoice twice because the vendor invoice is not there, right? So you can't trace it. So those are things, so the auditor failure to recognize exceptions or inappropriate or ineffective audit procedures, right? If the auditor doesn't design, so that's the importance of thinking about assertions, right? What are we trying to, if the management makes assertions about occurrence, the best way to test that assertion about occurrence, if we're talking about sales and collections, right, is to start with a sample of sales and tie those back to shipping documents, right? That tells us that the sale is a valid sale. If the auditor selects shipping documents and ties those back to the sales journal, that's an ineffective audit procedure to test occurrence. That only tells you that all of the items that are valid items have been included in the sales journal. It doesn't tell you that the sales journal only includes valid sales, right? So that's an ineffective audit procedure to test occurrence. Right? So that's what we call non-sampling risk. How do we address that? By training and supervision. Think about the third standard of fieldwork. The first standard, right? In terms of auditors have to be trained. They have to be knowledgeable about the areas that they're auditing. They have to be properly supervised. That's GAS. Reasonable working conditions and effort, right? So it's only so much. A big part of it is the auditor, right? The auditor has to be knowledgeable. They have to recognize when they don't know something, so they ask questions, and it has to be an environment that allows for that, right? It has to be proper review and feedback so that auditors are learning, and auditors have to put forth the effort to do the appropriate work. Some of the sampling approaches would be things that you see most commonly and probably expected is statistical sampling methods. And statistical sampling methods, again, as I said, most firms will have their own statistical approaches and their statistical packages. And so you're going to, if you go to work for a firm, you're going to be trained in using their statistical software. You select sample items and evaluate the sample results. Right? So because once we select the sample items, we're testing them for something, right? If we select a sample of cash disbursements, we're gathering information about that. We're gathering information about controls, and we're gathering information about the account balance, that transaction actually occurred, right? Then you evaluate those sample results based on, okay, and remember, when you select a sample, and you test that sample, if you have errors, you're going to have to extrapolate those errors to the entire population because you're selecting a representative sample. You should be selecting a representative sample that tells you something about the population, right? So if there are exceptions in your testing, you have to extrapolate that back to the entire population because what you're basically saying is if this is a representative sample, then if I have exceptions in my sample, there's probably a really good chance that there are more exceptions in the entire population. Statistical sampling methods measure the auditor's exposure to sampling risk, right? So the more refined that you can get your sample selection by using statistical methods, that reduces your risk. You have more control over your audit risk in a sense. Non-statistical sampling violates one or both of the above criteria, right? Because non-statistical sampling is kind of haphazard. You don't know necessarily, you don't have and statistical methods are based on mathematical methods, right? So you don't know if you've actually covered or addressed your audit risk in there because you don't know. There might be some bias in how you select those items. The one thing with statistical sampling is that it takes out the bias, right? It takes out the user bias. You're not going through, say, if you're doing non-statistical sampling, you're kind of, and I think the textbook is an example, you pick a number and just start flipping through a book and, eyeballing and say, oh, I want to look at this. Oh, this kind of looks good. I'll look at this, right? There might be some bias. You might not like them. You might see something, the last name Brown, and say, oof, remember that professor, Brown, don't like her. So I'm going to audit this guy with the last name Brown. No good ever comes from the last name Brown, right? Not true, but, right? So, there could be some bias that or something, like, ooh, I want to see more about this person, right? So you bring some bias in there, right? It's the possibility that there's user bias, and you're not really controlling your risk, right? Then you can use both, though. The standards don't say you can't use non-statistical sampling, right? It does allow you to use that. And there'll be times when you use non-statistical sampling, but the other thing you have to remember is you have to document your approach and why you took the approach that you did. And so that's not to say that non-statistical sampling isn't a viable option, and you will see non-statistical sampling being used on things such as, let's say, accounts receivable. If you make a decision to look at, large accounts, basically what you're doing is saying, okay, I'm going to have a statistical sampling on all accounts under 50,000, and I'm going to look at, randomly select 10 accounts to over 50,000. Or I might look at all accounts over 100,000, right? You're covering the entire population, and you'll see that. So you're covering the entire population of all accounts over 100,000, meaning, let's say you're going to confirm all accounts receivable over 100,000, and then you're going to perform statistical sampling on all those accounts under 50,000. So you're using an approach of looking at both methods. One of the things I said is that it's important to ensure that your sample represents characteristics of the population. So in other words, if you're trying to test internal controls over cash disbursements, right, you're not going to start with purchase orders, right? Purchase orders are initiates, is the initiation process or the initiation point of that eventually leads to a cash disbursement. Right? There are characteristics in testing cash disbursements that you'd want to see the purchase order, right? That's an attribute or of controls over cash disbursements, but you're not going to start with purchase orders to test cash disbursements, right? You're going to start with the cash disbursements journal and select a sample of items from the cash disbursements journal and tie those back to the three documents that I talked about. Right? So but you also want to make sure that your sample includes the entire population. That when you're making that sample selection, that you have the entire population. So again, you want to make sure that it represents the entire population and that you're including the entire population in there. In terms of selecting it, this is where understanding your client comes in, right? And this is where understanding the transactions, understanding the various documents as well as journals that are included in that business cycle. So remember when we talked about both the sales and collection cycle and the acquisition and expenditure cycle, one of the first slides we talked about was what constitutes audit evidence in each of those cycles. What files and documents will auditors use as audit evidence? So and again, understanding how your client records their transactions are important, because that is going to help you identify that you are getting a representative sample, what documents drive the transactions, so that you are selecting the appropriate documents for your sample selection. So an auditor has to be very careful in designing and approaching the sampling process and selection, as well as then evaluating those results. You can't evaluate the results of a control if you don't fully understand the control. Because if you don't fully understand the control, you're not going to know what constitutes an exception or a deviation from that control. In order to minimize the sampling risk, obviously you can adjust your sampling size. So if you think about risk, right, the more information you know, that should reduce your risk. So the more items you look at, if you plan your sample approach appropriately and effectively, that should also help to reduce and minimize your risk. And use the appropriate sample selection method, right? So use statistical sampling. Statistical sampling is going to minimize your risk versus non-statistical sampling. So that's how you minimize. Adjust your sample size and use the appropriate sample selection method. So again, with your risk, you have audit efficiency versus audit effectiveness. Sampling allows you to have efficiency, right, because you can't look at 100% of the items, but the trade-off is that you lose some level of effectiveness. So your effectiveness loss risk is that you over-rely. Right? There's an over-reliance. In other words, you assess internal control risk as too low. Right? What happens if you assess internal control risk as too low? From the audit risk model, what's the connection? You assess internal control risk as too low. What is that going to do to your detection risk and your substantive, your audit testing? Good thing the exam's not cumulative, huh? That means, right, you're willing to accept, right, a greater risk that you won't find something. That's what basically happens, right? Because if you assess internal control, you're willing to accept that your audit procedures will not uncover a significant or material misstatement, right? Because if you assess internal control risk as low, what you're saying as an auditor is that I can rely on internal controls. And because I can rely on internal controls, I'm going to focus my testing more on tested controls, and I'm going to reduce my substantive testing, right? I'm basically saying the process works. So I don't have to look at as many transactions because the process works. I'm convinced that the process works, right? So your risk in assessing it too low is that you could, not uncover a material misstatement. So you risk of incorrect acceptance. That's your risk. You risk when you set your internal controls too low, you over-rely on internal controls, you can accept that sample, your results from your sample, is representative of the entire population, that there are no material misstatements, right? So that's what we call an incorrect acceptance. Because you did not, by setting your internal controls that low or too low, you have not looked at a number. You're going to reduce your sample size as a result of that. And what happens if you reduce your sample size? You increase your risk. In terms of your efficiency losses, it's the risk of under-reliance, which is the opposite. You assess internal control risk is too high. And you can see why that would lead to an efficiency loss, right? Because if you set internal control risk too high, so in other words, you say, I can't rely on internal controls, or I have concerns about internal controls. So as a result of that, I'm going to perform more testing. I'm going to look at more transactions. There's a cost to looking at more transactions. There's a cost of time, and obviously the cost of money, right? So that makes your audit approach less efficient. That time that you're spending, you could be looking at other things that might be higher risk. So if you haven't set your internal, if you over-rely, if you assess your control risk under-rely on internal controls, then you run the risk of incorrect rejection, right? So basically what you've done is that I can't rely on internal controls, and so therefore, I'm going to perform more substantive tests. So let's talk about our sampling approach. So what you have to first start out with is what's the objective of the audit test, Right? Are you testing controls or are you testing account balances? Right? And then the importance with this is because you have to be able to identify what constitutes an exception. Right? If the objective of your test, again, is to test that the cash disbursements are, valid, that they actually occurred, right? Then you want to look at things, as I said, purchase order, receiving report, and vendor invoice, right? So you want to test that that control is operating. If those documents are missing, that's an exception. So you have to be able to identify what is the objective of my test. So I'm testing operating effectiveness of internal controls. Then these are the kinds of attributes that exist for this particular control. And if those attributes are missing, then I have an exception. So clearly state the objective of your audit test. Decide whether audit sampling applies. So in that case, audit sampling applies. Right? If you're testing the effectiveness of operating controls, then audit sampling applies because you're going to look at number of transactions and controls and see if those controls are being met, right? Or if to ensure that there are no breakdowns in internal controls, right? So you want to be able to identify where there might be exceptions. So you're going to draw a conclusion from that sample about the effectiveness in terms of the operation of that particular control. If your audit objective is to look at high risk accounts receivable balances, then sampling might not be the appropriate approach, right? Then you would look to non-statistical. You wouldn't sample. So sampling doesn't work in that case because you don't want every other high risk. You want to look at, if your objective is to look at all high risk accounts receivable, then that's not the approach you're going to use, right? Sampling is not the approach you're going to use. You're going to look at 100% of those items. You're going to identify what constitutes a high-risk accounts receivable, and then you're going to select all those accounts receivables that meet that criteria. So again, the importance of deciding whether or not audit sampling applies. Define what attributes and exception, the attributes and exception conditions. So what we mean here is, if you're testing, again, testing attributes is a test of internal controls. So you have to define the attributes of that control, right? Going back to the disbursement problem example. The attributes that I look for, as the auditor will look for, would be a three-way match. So you look for all three of those documents. If you're testing occurrence with respect to the sales and collection cycle, or you're testing, then you would look to see that a shipping document supports the items recorded in the sales journal. So again, you select a sample of items from the sales journal and ensure that a shipping document is included or supports that item in the sales journal. Right? And so by setting the attributes, then that tells you, then you should be able to identify the exception if those attributes are missing. So if there's no shipping document, that's an exception. If there's no purchase order or voucher package with those three items, a purchase order, receiving report, and vendor invoice, that's an exception. So again, as you're going through this process of understanding your client's internal controls, you're identifying what attributes make up those controls. Okay, and if those attributes are not there, then that's an exception. Define the population. This is where completeness is extremely important. So if you're looking at sales, the population would be all sales recorded in the sales journal. If you're looking at cash disbursements, all disbursements recorded in the cash disbursements journal. So you want to reconcile that you have all of the information or all of the transactions that occurred for sales or all of the transactions that occurred for cash disbursements. Define what the sampling unit is, and that must be consistent with your audit objective. So if your audit objective, again, is to test occurrence and controls over the recording of sales transactions, then your sampling unit, right, you're going to start with the sales journal, right, because you want to know that sales are valid. Right? Your audit objective is to test that the sales recorded are valid, that they actually occurred. So you're going to start with the sampling unit of the sales journal, and you're going to get documentation to support that, shipping documents to support that sales are valid. If your audit objective is to test cash disbursements, and that cash disbursements are valid, you're going to, again, your sampling unit is going to be from your cash disbursement journal, and you're going to get documentation to support, look at the documentation to support that disbursements were only recorded after this three-way match occurred. Okay? Specify your tolerable rate of deviation. And what this means is you have to decide, and this is where, so sampling involves judgment on the auditor's part. And you as the auditor have to decide how much deviation you're willing to accept. So what's your acceptable rate of exceptions? Right? So if you believe or you're satisfied that 95% of the transactions being recorded in accordance with the firm's control policies, that means you're willing to accept the 5%. Your tolerable rate of deviation is 5%. You're willing to accept that in your sampling. And that, again, is judgment that firms will have guidelines on that. And, so it's not like you have to kind of pull this number out of your head. Like, oh, I feel like 5% today, right? That's not good. Right? So firms will have guidance on that in terms of what would be suggestions for tolerable deviation rates, and you as an auditor or would have to decide if you're going to deviate from that or not, right? But you have to document that. So obviously we want to specify, we should be willing to specify a low tolerable rate of deviation. You certainly wouldn't be willing to tolerate a 50% rate of deviation. That's not going to give you a lot of comfort in your findings. And specify the acceptable risk of assessing control risk too low. Again, what are you willing to accept? What risk are you willing to accept that you have assessed internal control risk too low? Right? Because if you've assessed internal control risk too low, that means that you are over-relying. Right? So what amount of risk are you willing to accept? Same thing as the tolerable deviation rate. And you'll see that there are tables. When we go through this, we'll talk about the tables, right? There are AICPA tables that usually see 5% and 10%. Estimate what the population exception rate is, right? So you expect that there's going to be some, some exception rate based on prior experience, based on what you know about the client, right? And testing internal controls from the prior period. And then you estimate what that population exception rate is, so that you know that there's some built in, that there's going to be some exceptions. From that, you determine the initial sample size, and you can use this, again, this is where the tables come in, the AICPA tables you plug in. We'll go through some examples where you plug in these criteria, and then that gives you what your sample size should be. So that's your planning your sample. Now you have to go ahead and actually perform the audit procedures and select your the sample. Again, if you're looking at sales journals, right, if you're testing sales and controls over sales, then you're going to look at items in the sales and collection cycle, such as the sales journal, shipping documents. So you're going to select the sample and perform your audit procedures on that sample. And typically what you'll see is that you'll select a sample and you'll perform several audit procedures on that sample, right? So think about if you select a sample of sales from the sales journal, right? You can test occurrence with that. You can test accuracy with that. You can test cutoff to a certain extent with that, right? So you can perform several audit procedures on that one sample. Once you have selected your sample and performed your audit procedures, you have to evaluate the results of your testing. Right? And you have to determine what are my exceptions, analyze those exceptions, and you have to extend that back, generalize that to the entire population. And what does that mean? And think about whether or not, okay, can I accept this, right? But when I extrapolate that back or generalize that back to the entire population, then I have to decide on the acceptability of these results considering the entire population. And then an auditor decides, well, does this tell me that there's a material misstatement? Do I need to go back and do more work, gather more, a larger sample? That's the auditor's decision or judgment. We'll talk about variable sampling next week, but basically variable sampling estimates the amount or value of some characteristic of a population. So that's the difference. You're looking at the amount, value of something, whereas attribute sampling is looking at attributes and internal controls. We use variable sampling with substantive procedures, right? Because substantive procedures, we're testing detail balances, or we're testing, amounts about, the transactions. We might look at a specific transaction amount or value of that transaction. You want to basically, obviously, understand the misstatement that might be present in that account balance or class of transactions, and you've already set your tolerable misstatement. Remember when we talked about materiality way back in the beginning of the course, and we talked about tolerable misstatement? That's how much misstatement you're willing to accept in that account, right? Because we recognize that there's the possibility of a misstatement, and we have a tolerable misstatement that we're willing to accept. And we try not to, you don't want to exceed that tolerable misstatement, because if you exceed that tolerable misstatement, then you're basically, what you're saying is that the account contains material misstatement. So in evaluating the account balance or value in that account, you're evaluating it against your tolerable misstatement, or you're looking at the materiality. How material is that misstatement or error that you find? So again, as I said, we'll talk about this next week, but there are two types: monetary unit sampling and classical variable sampling. I'll talk about that. I'll go into that more on next week. So let's get back to attribute sampling. As I said, with attribute sampling, you're looking at attributes and testing internal controls. You want to estimate the extent to which that characteristic, right, whether it's shipping documents, so their shipping documents to support sales in the sales journal, exists within the population, right? So if again, specifying what your audit objective is. If your audit objective is to test the occurrence of sales, you want to know that for that population of sales, that they're valid, that they're supported by shipping documents. So you want to compare it, estimate the rate that internal controls might not be operating effectively, and again, compare that to your tolerable rate of deviation. The difference with accounts is you have a tolerable misstatement. That's a value, an amount, right? With internal controls or attribute sampling, you have to determine what your tolerable rate of deviation is. How much are you willing to accept that this control is not operating effectively? What percentage? Right? Are you willing to, do you want to get controls in a 95% range or a 90% range? Right? And that's specified. And that again is just like tolerable misstatement is based on the auditor's judgment, so is the tolerable deviation. So this is right out of your text, but sampling risk associated with attribute sampling. You have, as I said, the risk of under-reliance and the risk of over-reliance. The risk of over-reliance will result in an incorrect acceptance, and the risk of under-reliance will result in an incorrect rejection of the population. So if you have under-reliance, and that's the risk of assessing control risk too high, your adjusted sample rate of deviation is going to be greater than your tolerable rate of deviation. And so you're going to conclude that that control is not functioning, right? And here, in this case, What that means is you lose efficiency, right? Because you're going to perform these additional substantive procedures that you don't necessarily have to perform. It's because you did not correctly identify your reliance on internal controls. You're going to conclude that control is not functioning. If, with respect to your risk of over-reliance, assessing control risk too low, it's the opposite. Your adjusted sample rate of deviation is going to be less than or equal to your tolerable rate of deviation, and then you're going to assess that controls are functioning. And then there's an effectiveness loss, obviously, because you haven't performed sufficient level of testing, right, of substantive procedures. And so it's going to increase the likelihood that you won't detect a material misstatement in the account. Okay. Some of the factors affecting sample size would be things like sampling risk, which is based on the audit team's judgment. So in this case, you usually see that the risk is usually set too low, and it has an inverse effect on the sample size. So as sampling risk decreases, sampling size increases. So it's an inverse relationship. So remember the sampling meter, right? If you want to reduce your sampling risk, you're going to adjust the sample size. The tolerable rate of deviation, which this is the level of control risk, and the degree of assurance that the auditor requires. So if you, again, think about, if you want a greater confidence level, right, so for example, 95% confidence level, you're going to reduce your tolerable rate of deviation. And so as a result, you're going to look at more items, right? So you decrease the tolerable rate of deviation, and so the effect on your sample size is that you're going to look at more items, right? Because you want a greater confidence around your sample. So it's an inverse relationship. As your acceptable tolerable rate of deviation decreases, your sample size increases, right? Because what that basically says, when you decrease your tolerable deviation rate, you're willing to accept less risk, right? And if you accept less risk, you need more information. So if you just think about it intuitively. The expected population deviation rate, as I said, this is based on the auditor's experience, more than likely coming from prior audits, or if it's a new client based on the auditor's initial test of internal controls in a pilot, in the planning phase, right? So there's a direct relationship. As your expected population deviation rate increases, so you're expecting higher amounts of exceptions, then your sample size is going to increase, right? So it's a direct relationship. If it's known to me that based on prior experience, that this particular control that I'm testing, there's this level of exceptions. I know this from prior period. I'm going to plan for that. So I'm going to look at more items, right? Because by saying that I have this expectation of deviation, that increases my risk, right? So I have to compensate for that to keep my risk at an acceptable level, so I'm going to look at more items. So sample size increases. Population size, the number of applications of a control policy or procedures to a transaction is going to be direct. So as population size increases, sample size increases. However, that is not always the case. Once the population reaches a certain level, it's negligible, right? So it's not always that you're going to I have a larger population, so I'm going to look at more transactions. There are other things that you have to consider that we went over: your sampling risk, your tolerable deviation, your expected population deviation. So, and that is going to determine, because if you think about it from a practical standpoint, if you deem internal controls are effective, it doesn't, and you've tested internal controls and you're like, these controls really work, the client has strong and effective internal controls. If the client has 500,000 transactions, those internal controls are effective. They're going to operate the same way all the time. So if based on your prior experience and what you know about that client and the internal controls, what you're willing to accept in terms of risk, that doesn't mean now you have to look at 50,000 items, right? Because think about internal controls. The process happens the same way, it should happen the same way all the time. So that, you can't just look at the size as the only factor, right? You have to consider the expected population deviation rate, the sampling risk, and the tolerable deviation rate. Any questions? Yeah. So you can't just assume that because the client has 500,000 items, that means that I have to look at even more transactions, right? Because you're going to set the number of transactions, and you'll see this when you're looking at the tables, you're going to set the number that you look at based on your sampling risk, your tolerable rate of deviation, and your expected population deviation rate. That's really going to drive what your sample size is going to be, right? And again, as I said, internal controls, the process happens or should happen the same way all the time. So whether you have 500 transactions or 500,000 transactions, if your internal controls are effective and you as an auditor judge that you can rely on those internal controls, then basically what are you saying? It's happening the same way. So once I get a comfort level around my tolerable rate of deviation, right, what I'm willing to accept, then I don't need to look at 500,000 transactions just because there are 500,000 transactions necessarily. So that's where the tables come in, and you'll see the relationship. So there's a caveat with the population size. How do we determine sample size? Again, I kept talking about these AICPA sample size tables, and if you look in your text, I think in Module F, pretty sure it's in Module F. Yes. And it might be in Module, let's see. Yes, it's in Module F when we talk about attributed sampling. So if you look at Exhibit F6 and Exhibit F7, right, you'll see it's on page, well, if you have the custom text, it's page 598. If you have the full text, it's page 760, or the ebook, it's page 760. So it's Module F, and you'll see that there's Exhibit F6 and Exhibit F7, and F6 deals with the sample size table for 5% risk of over-reliance, right? So that's your number of expected deviations, right? So what you're trying to find is based on my expected population deviation rate, my tolerable rate of deviation, what would be my sample size, right? So that's what I said. Your population, your sample size is going to really be driven by those two things. And then Exhibit F7 is if the auditor is willing to accept a 10% risk of over-reliance on internal control. So it's whether your confidence interval is 95% or 90%. And the table, those two tables provide you with that. And that's what you base your sample size on. Okay, and those are the AICPA tables. For example, right, if you have the risk of over-reliance of 5%, you would look at table F6, right? And if your expected population deviation rate is 2%, that's the first column. The tolerable rate of deviation is 7%. That's across the rows, right? Across the columns, I mean. Then your sample size is going to be 88. Did you find that? You're at table F6. Your population deviation rate is 2%. Your tolerable rate of deviation is 7%. Everyone get that? That's it. So you see what's driving your sample size. It has nothing in there about population, right? What's driving your sample size are those three parameters. you have to make a decision. So now you have to decide as an auditor what's your upper level rate of deviation. That's the ULRD, upper level rate of deviation. And if that is less than your tolerable, greater than your tolerable rate of deviation, then basically what you're saying, if something is greater than your tolerable rate of deviation, you're basically saying, I can't rely on this. The controls are not operating effectively, right? Conclude that internal control is not functioning effectively. Then you have to decide, what do I do next? Right? I've done this test, what do I do next? The auditor can make a decision of whether or not they're going to increase the sample size in hopes of supporting their planned level of controlled risk, because remember, you set a planned level of control risk back in the planning stage, right? You assess internal control risk as either effective or not. You can increase your level of control risk, leading to more effective substantive procedures, lower detection risk. You want to lower your risk that your auditing procedures will not detect a material misstatement or an exception in the case of internal controls. Right? So what this is saying to you is that you, as an auditor, that control risk assessment is not static. Right? It's not, I made that back in the planning stage so it stays as it is. It's not static. You have to address that, right? So in either event, it means doing additional work. Because if you increase your sample size, you're going to have to test those items again, right? You're going to have to test more items. Or you increase your level of control risk, so you've adjusted control risk, that means you do more substantive testing. So it's a trade-off between the auditor makes a decision about whether they're going to do additional tested transactions and tested controls, or are they going to do more substantive detail testing, substantive tested details. Right. That's their decision, but it involves doing more work. So you wouldn't necessarily say, oh, controls are not functioning, they're material misstatements, I'm going to give an adverse opinion or a qualified opinion. Make sense? If your upper level rate of deviation is less than or equal to your tolerable rate of deviation, then you can conclude that the internal controls are operating effectively. Right? What you do is maintain your planned level of control risk. You can basically say, okay, well, as I suspected or assessed in my planning stage, control risk is as I expected. So now I'm just going to move ahead and follow my audit plan from the start, from the beginning, and do my plan effectiveness of substantive procedures, right? Test those. And determine the cause of the detected deviations. Because remember, right, you might not find something that leads to where you conclude that there's a material misstatement, but there are deviations. And so you want to determine what the deviations are. Because as auditors, you have to give an opinion, you're issuing an opinion on the report of internal controls, right? Internal controls over financial reporting. So it's important to understand the nature of those deviations. Also from a more, providing some feedback to your client, you want to, talk to them about deviations that you found so that they know. Okay. So again, this is just getting to the point and highlighting that you have to generalize back to the entire population. There's no such thing as an isolated misstatement, right? Because if you are, just by the mere fact of sampling, what you're doing is saying you're making a decision based on a few items about the entire population. So it's not, you can't have it where, okay, I'll take this sample to increase my efficiency, but if I find exceptions, I'm not going to worry about it. You have to, right? You have to go back and see what the impact of those exceptions are on the entire population, right? If your sample is representative of the population, then the exceptions that result from your testing has to be representative of the population as well. So you have to tie that back. So documentation, key, right? Because there's a lot of judgment involved in this. Your tolerable rate of deviation, your expected population deviation, your confidence levels. So if you have to document your judgments about the factors that affect your sample size and the rationale for those factors. And those factors, again, are the amount of over-reliance you're willing to place on controls, your tolerable deviation rate, and your expected population deviation rate. Why you chose the sampling method that you chose. How you measured your sample items, and a summary of those measurements. And that's your audit procedures, right? And then your evaluation of your sample results and the overall conclusion. So again, if you found misstatements, you generalize those back. Deviations, you generalize those back, and you document, if you found that your sample, your exceptions exceeded your tolerable deviation rate, what steps did you take next and why you took those steps. So it's extremely important to document.